Boom. All right, Alex should be here shortly. Glad to see the room's filling up, guys. Welcome to the profit panel. This is kind of what I do in the very beginning. I just kind of look at the market, go over some trades that I'm in. And there's JD. He snuck in here. I didn't even see him.
Hey, hey,
How are you?
I'm good. How are you?
I'm doing great. It's nice to meet you. I don't think we've officially met before, but I've done some of your webinars on my evening edge, and they've always done great. So I love it.
Oh, cool.
What's up, dude?
What's up, Alex? Welcome in.
Good to see you both.
Yeah, you too,
Hey,
man.
All right. All right. All right. All right. What comedian said that? All right. All right. All right.
Matthew McConaughey, didn't he? And Dazed and Confused.
Oh, was that Matthew McConaughey? I
I,
thought it was just some stand-up comedian. I remember back watching it. Maybe I'm mixing it up. Nice. All right. All right. All right.
although he was stoned.
Yeah, what a good movie. He's a fun actor, man. I like Matthew McConaughey.
I like his
Um,
performance on Wolf of Wall Street. That was one of my all-time favorites for him.
Dude, I loved his performance in Tropic Thunder.
Oh
He
my
was
gosh, that's a good movie too.
he was Ben Stiller's agent. He's like
It's,
he's like Ben Stiller's like I killed the thing, he kills like a panda in the Vietnamese wilderness. He's like calls the agent, he's like I killed the thing I love the most. Matthew McConaughey's like a hooker. You killed a hooker. Okay, here's what you need to do. You need to get some bleach and a tarp. He's like, no, I killed a panda.
That's
Oh my
horrible.
gosh. Yeah,
oh, that's
it's
funny.
um all right, folks. How are we doing today? So we got Jamie here. This is his first appearance on Profit Panel. So say hi to Jamie, everyone. He's gonna be showing you something about a really cool strategy he's got later on in this. But how this is this is actually gonna be a really jam-packed session today.
Oh yeah.
We're not gonna spend much time. Um, we're not gonna. Oh, okay, you got UAL. Oh, AK, what'd you get on UAL today? I didn't send out like any testimonial requests for that, but I mean, because I should. I mean, if you anytime you do get a winner, like, and I don't say, hey, send me an email, please send me an email anyways, because like I like hearing them. Obviously, and I want to collect all those testimonials so people know that people are trading with this stuff and having success. Um, but cool. Can you give me some percentage gains on that, K? Or money gains or whatever, just to, like, to anchor that. Um, cool. Okay, cool. Yeah. Blake, can you grab that if you don't mind, my man?
Absolutely.
Cool stuff. So we got a packed episode today. I am going to be doing some stuff. Oh, nice. Bea made 100% on Poet overnight. Yeah, that thing is. I mean, we got out. Honestly, it's up. It was up more now, but um yeah, Teva is I'm gonna hold Teva. I think we're pumping a little bit here right now back, but I think so. I'll show you why I'm doing holding on Teva. Um, go ahead and let me pull up my options chain here. Where's
Yeah, you can
Teva?
have the screen back too if you want it.
Yeah, I'll share it. Let me just get this over here before I do that.
Oh yeah.
Um, boom, detach. Uh, look at this here. So wait, is this the right? Yes, this is the right one. All right, so share screen. Replace. I'm replacing you, Blake.
Replace it.
You're
Do it.
replaceable. You're replaceable. That's the
Hey
truth.
now.
So look at this. So the taper position is down. Um but look at this, look at the volume differential. 183 and 59 on the put side. 33,000, right? Now not only was there if you see the flows here today, we got into it a little late. Um, if I'm being honest. But we had the flows, and then if we come over here to the other scanner I built, we actually had another sweep came in for this at 21 call. Both are all on the 10-10. I mean, this is 24, but 10-10. We have a ton of extra volume over here. I think this is pretty, I'm still pretty, I mean, sometimes we have to hold, sometimes we can't get winners in 20 minutes. Unfortunately, it doesn't always work out like that. But we're going to keep on holding that. So maybe into tomorrow. You can see here we have a little bit of a pump. Or I don't know if it's a pump, but it's a recovery, right? We'll see what happens as we go through today. This profit panel, we'll see what happens. Maybe reevaluate, but I think I'm going to hold it overnight. Because there is, if you scroll out to the 1-day chart on TEVA, big L gap down. We're just filling the gap. It's not always like it works out like this, but I will say that one, we have a big upswing and price consolidation happening right now, which typically is a trend continuation pattern. So up, consolidate, up. Likewise, down, consolidate, down, right? Again, not perfect, but it tends to happen that way. And also, we want to fill this gap. We're just filling it, but I don't. Once you fill the gap, I tend to believe that oftentimes it wants to stay at that gap fill, and that forms a support line. So that's why we're going to stay in. All right. So yeah, that is that.
Solid.
Crystal. And then, okay, so real quick, let's go ahead and set some so we have a ton of debit spreads open right now. I think I'm looking at 1, 2, 3, 4, 5. One of them is from the opening playbook roundtable we did last week, silver, which is up 81%. But MU is up 23%, IBM's up 76%, and Cisco's up 58%. So what we're going to do is, well, Crystal, hey, options training is coming up in a second. I'm gonna do this in 2 minutes, and then we're going to get into this options training. We're going to look at the flows after that, and then we're going to get into talking about Jamie's cool thing that he's got. I really like it. So here we go. So I want you to, you can do what you want, but what I'm doing, come on, Zoom, whatever the software's called. I set some good to close orders on all of our stuff. So, what is my good to close orders? Okay, so SLV. So if you are in SLV, you might, I didn't send this out to profit panel, but if you came to opening playbook, SLV GTC at $1. MU GTC at 155. Cisco GTC at 1, and IBM GTC at 250.
And those are just for the trades that we've put out on the profit panel.
Yeah. So
Okay.
So if you followed all of them, you probably have them open in your brokerage. You haven't cashed out yet. Now, I just want to set these as we're nearing some of the expiration dates. If we get a pop, it'll automatically fill for us. We may notch it down. We may not hit these amounts, but we're still in really positive gain territory for all of them. So we might notch it down as we get like into Friday this week, or maybe even early next week, because a lot of them are October 17th. But you might as well set those, and we'll see if we get like a nice little spike intraday, it could work out for everyone. So go ahead and set those. Open. So open's another one. Again, I'm still in it. I'm going to stay in it because even today, look at all these contracts coming in for $10. Some are coming in for 9 as well, but it's still bullish price action on the 10. See, look, ton of contracts being traded for 10. So I'm going to stay in open. These are all high conviction. Repeated hits, ascending fill means that the sweeps are basically they don't care what good. They're not trying to shop around for the best price. When you see this, so it's purple. Sometimes it just says repeated hits. That's just a sweep. But purple with repeated hits, ascending fill means that they're executing these sweeps across all the different exchanges, and they don't care about shopping around for the best price. They're like, get me into this at whatever best price, at whatever price you can get me into ASAP. So that's when you see ascending fill, because as they buy into it, that option is going to go up, and they're just like, I don't care. I want into this position. So I'm going to hold that. We have a bounce off of the 9. Like I said, there's been a lot of bearish action, and earlier today it was actually, the wick was really long, if you saw my Telegram update, but I'm going to stay in this, okay? So that being said, let me go ahead and move this over here.
Just to kind of preface for Jamie here. So essentially what we're doing today is we have, and I want to make sure I get this right. So we're doing, what is it, credit spreads today, Alex? We're looking at credit spreads that can pay us by Friday.
Yeah, we do have, we're looking at credit spreads that can pay us by Friday. I don't know, but that's why I wanted to do this training today, because this matters for credit spreads. So what are you going to teach you? All right.
So can I jump in and ask a really naive question, because I'm new here, and if it helps the audience all the better. When you say you're doing credit spread, are these credits that you've collected and then the options expire on Friday? Is that what the structure you're using?
Yeah, well, we open a Wednesday trade. We open it on Wednesdays.
Okay, and you did that already on this morning?
No, we do it online. We do it on camera during the sessions. Yeah. Yes, I have like a scanner. We go through, we look at the tickers, and we
Cool.
get support and resistance levels, and we build a credit spread off of that. Now can everybody see this theta burn thing? Yeah. Am I good, Blake or Jamie?
Yeah, we can see you. You're
All right,
good.
so theta burn, right? This is going to be really important for spreads. What is theta burn? How to use it to improve your options win rate? What is theta? Right? Theta is time decay in options pricing. It represents how much value an option loses per day as expiration approaches, all else being equal. There's other factors, but we're just going to isolate theta for today for explanatory purposes. My mustache is itching my nose. Excuse me. But expressed as a negative number, theta is for options buyers, positive for sellers. You can see that here, because for buyers, theta is a decay measure, right? It's just how much the option's losing. That's why it's a negative value. For both puts and calls, right? Doesn't matter if you're going long a put, long a call, it's going to decay in value as time progresses. A theta of negative 0.05 means the option loses $5 per contract per day. Okay. So if you see over here, the theta is negative 0.05, loses $5. This 0.2 means it loses $20 per day, or 20 cents per day, rather. So $20 per contract per day, sorry. $20 per, so this 350 contract by tomorrow will be worth 330, all else being equal. The price doesn't move at all, right? Now, why does theta matter? Because options are wasting assets. Every time you buy a call, buy a put, it's a wasting asset. It's going down as time passes. Now, it's the opposite if you sell it. If you're writing an option, you're selling an option, you're benefiting from time decay, right? Now, how does theta influence prices? So let's look at this little option strat chart, which if you've been here, I love option strat. Recommend everybody at least get a free trial of it. I think you can get, or, honestly, if you trade a lot of options, you probably should just pay for it because it'll be worth it on your P&L. So you can see here, at the money options decay the fastest. You can see the rate of decay. This is the theta view on option strat. Theta decays the fastest at the money option. So I took this like a couple weeks ago when silver was at $42. So basically look at the 42 or the 43, right around there, the at the money calls. You can see the theta decay, right? This is how much it's losing per day, 1.96, 2.0, 2.10, 2.15. So it's accelerating as we go on the at the money side, right? Now, why do at the money? Because you think at the money, that's the price it's trading at. Why would it decay the fastest if silver's at 42 and the call is at 42? That's because at the money options have strike prices. Again, they're very near the underlying asset price. So silver 42, call option 42, at the money call. Now, since at the money options are so close to being in the money, right? Which means it'd be basically if silver moves up to 43, the option is that $42 call is now what? It's not at the money anymore. It's in the money. Because of that, though, the probability of them becoming profitable or remaining unprofitable can change quickly. It vacillates, right? Because the price only has to move a little way for that to change, whether they're in the money or at the money or out of the money. The price only has to change a little bit for that $42 call to become a different type of moneyness in terms of an option, right? So this uncertainty contributes to their higher premium, which is why you pay more for them, and it's also responsible for their faster time burn. Now, if you ever heard of these terms, this means that at the money options have the most time value, extrinsic value, and the least or no intrinsic value. Time value is a portion of the options premium that is subject to theta decay. So at the money options having the most time value makes them the most vulnerable to theta decay. Now, as an option approaches its expiration date, like you saw in that chart, and we'll show you again, its time value diminishes at an accelerating rate, right? It's a hockey stick curve, logarithmic curve. At the money options with their higher initial extrinsic value experience this decay more intensely in the final period before expiration. It says weeks here. If you're taking a 45-day out option, it'll start to kick in at day 30 in a real way. Theta decay will. But if you're taking a weekly option, it'll start to kick in a real way Thursday afternoon. So it's always at basically the last, I don't know, a little less than a quarter of the way to the expiration date. So, weekly on Friday, you're not going to see as much theta decay on Tuesday. You're going to see a lot more on Thursday. Same with zero DTE. The theta decay works for zero DTE options. You're not going to see a lot of theta decay early in the morning. Come 2 p.m. though, you're going to see a lot of theta decay on those, right? Now, out of the money options are different, right? Because they're out of the money, right? So if silver's trading at 42 and out of the money option would be 47 or 49 or 50, right? Because it's not close to that strike price. It's not close to the underlying price. They lose value steadily, more steadily. And you can see that here. So if you look at the at the money, the theta decay, not only is it a greater real nominal value, but it actually accelerates as we get closer to expiration. So go up here to 52 though, that rate of decay, instead of $1.96, it's only 73 cents, right? Now, not only that, but it doesn't change as much. It doesn't accelerate as much, right? It doesn't accelerate quite as much versus here, right? You can see it's even higher on the out of the money, 55, right? It's even less, right? Why in the money options they're not out of the money, right? So if silver's trading at $42 and in the money option, deep in the money would be like $33, right? Because the price is already there. That means in the money. You can see that here, down here, where my little cursor is. In the money options have intrinsic value because they are already at the price that the underlying is trading at. Intrinsic value does not decay as fast, right? Now their extrinsic value is lower than at the money options. They have more intrinsic value though, but since their extrinsic value is lower, and that's the most vulnerable thing to time decay, they have a slower decay rate as well. So both in the money and out of the money options have a slower decay rate than at the money options. Out of the money options, and then they're different than out of the money options. They don't have any intrinsic value, but they have a smaller amount of extrinsic value because they're so far out of the money than versus at the money options. They also decay at a slower rate, both in terms of acceleration and in terms of just nominal value. Now, here's the little graph I was talking about. Theta decay is a non-linear function of options. It accelerates as expiration gets closer. So this is on a 120-day time frame. So you can see here, you open it 120 days out. You're not going to have, the slope is not great. You're not going to have too much theta decay. It's always working and decaying, but not that rapidly. 90 days, though, it begins to accelerate. 60 days, it accelerates more. Now, come day 30 days out to that expiration, it's going to really kick into high gear, right? The theta decay accelerates until you reach the expiration date. So what are the key factors affecting theta burn? Well, time to expiration, obviously. The shorter time you have until expiration. So if you open a weekly that expires on Friday at 2 p.m. on Friday, it's going to be really fast decay on the theta curve, right? Because you're opening it really close to the expiration date. Implied volatility also matters. Higher IV slows decay because options are more expensive. And strike price proximity, like we talked about, at the money has the most theta burn, while in the money and out of the money options have less theta burn. So how do you use this to trade? Well, as a seller, if you do want to have theta work in your advantage, you can sell premium, which is just, selling the contract when decay is most aggressive, right? You can do that using credit spreads, condors, naked puts or calls, which are more advanced and riskier because their risk is uncapped, or covered calls. And you will profit if the stock stays within the expected range. This is a real world example on Apple, something we trade a lot for all the cash flow club folks here. If you look at this, so check this out. So if you can see here, this is a bear call spread. So basically you're selling a what we're selling, a 250 call and buying a 255 call, right? So basically, let's look at 254, right? If we open this contract, and this was from a few weeks ago, but if we open this contract, you can see our profitability, our P&L. We would basically, it would be down 1.5%. Actually, let's go here, because this wasn't the perfect example because actually you don't want to take it above the strike price. But let's say that Apple was at 251 when we opened it. Now you can see here with this spread where it is, we would be up by September 30th, up 7.4%. Now, let's say that the options market closed down for that entire time of this spread. We took them November 21st. So from November 21st, right, just like the government shut down, the options market shuts down. Now we executed our order. We're still in it, but nobody can trade. Nobody can do anything. And Apple's not moving because there's no volume, no trades happening on it. Now look at this. If Apple never moved from the minute we opened that trade, so no price action, no delta, none of the other stuff, simply because of theta decay, our position would go from being 7.4% profit to 8% profit the next week, to 9% profit the week after that, to 11%, 13%, 16%, 25%, all the way by expiration to 64% profit. And the stock would not have had to move at all, simply because of theta decay, because we did the call spread, which is a credit, which is basically your selling premium. Simply because of theta, we would be at a 64% profit on that trade if nothing else changed, right? Pretty cool, right? So that's if you're doing it as a seller, right? If you're collecting premium. Now, if you're doing it as a buyer, you have to be aware of theta because it'll work against you. You're fighting theta every time you open a call, every time you open a put. So you need to have a good reason and a catalyst for an options trade, long call side, long put side. Because if you don't, it's going to be very unlikely that you're going to win. Because if you buy, let's say Apple's trading at 250 and you buy a $260 call. So you're out of the money call. and Apple goes to 263, and the call is for 30 days out. Apple goes to 263, right, in 2 weeks. All right. And then 2 weeks later, Apple goes to your strike price that you bought of your call. But guess what? You might actually have still lost on that because it didn't move fast enough. And because it took the entire expiration length of the contract for Apple to reach your strike price, Theta just ate you alive. And so even if you were right, you might have still lost because of Theta. So it's really, really hard. That's why, with the unusual scanner I use, you have to have a clear sign that the price will move in the direction quickly that you're anticipating, or else it's not going to work out. Odds are, right?
Hey, Alex, can I just jump in real quick?
Of course, yeah.
I'm fascinated by this concept of Theta and love how you're breaking it down. And I'm wondering if I could maybe just in real time have you take a look at a recommendation that I actually made today in my Telegram. I do it all frequently with something that I call the mean reversion cash machine. And
Absolutely.
to your point on there needing to be a catalyst, what we're doing with the mean reversion cash machine is taking advantage of option pricing around earnings season, earnings being that catalyst. But isn't it true then with respect to Theta that if you accept the risk of there being Theta and you expect that fast move, you're going to pay a big premium for that because usually that's going to be priced into the option, is it not?
Yeah, which is why it's really hard to play options around earnings, because even if Micron moves 10%, you might have like taken if it's at 50 and then moves to 55 and you took the $55 call. It's just once earnings are over, IV collapses, and that option loses. You actually won. You were right, but IV collapsed, which is a function of Theta, and you lost. You still lost.
Yeah.
So it's really Theta is maybe one of the most important things for you to think about as a trader. But yeah, we can look at that ticker. I just let me wrap this up real quick.
Let me know when you're ready. I've got an interesting one for us to look at.
Yeah. So how to use Theta to improve your win rate, right? We're going to talk about that with Jamie, but just 3 things that I think is helpful. If you want to benefit from Theta, trade spreads instead of naked options. In terms of selling, right? As a seller. Naked options are risky, right? Naked calls or puts, selling them is really risky. Spreads always have defined risk. You always know exactly how much you can lose because you have that yes, you have a short strike, but that can lose infinite value. But you also have that long strike, which as that short strike loses value, the long strike will gain value. That's why they're defined risk. And if you want to try and sell options with high IV and short time left, because you can get not only can you get the price, less potential for the price to move against you, but you're also maximizing that Theta burn rate, the Theta decay. And again, what Jamie was talking about, if you're a buyer, and what I was saying, catalyst. What reason does this stock have to move up? And it doesn't have to be unusual options flows like we use. It can be whatever, but something, technical breakout pattern, a news event, something has to be the catalyst, the little tinder spark that will cause that option, or not the option, but the stock to move in the direction you want fast enough so the gains on the option will overpower any Theta decay that you have. So that's the quick and dirty. That's the quick and dirty on Theta. Now, yeah, let's look at what do you want to look at?
Okay, so in the structure of the mean reversion cash machine, what we're doing to take advantage of that option premium, we're not trying to buy an option because of the premium. We're trying to exploit that premium with what you were talking about earlier with credit spreads, and so we're just selling credits or selling puts or calls to collect the premium in advance of an earnings report, and using the weekly expiration option, so we don't have to worry about a lot of fluctuation due to time. Pepsi is the name that I recommended today, and the reason I like Pepsi to trade is because shares are trading around 2 standard deviations below the mean right now. And so, as the name implies, we're exploiting this idea that eventually markets will be efficient and a stock will return to its, for mathematical reasons that I'm going to explain later in my presentation, Alex, and I don't want to dive into that in advance, but generally speaking, a stock gravitates towards its mean. And so when you add on or layer onto that the fact that it's earnings season and premiums have jumped, it gives us an opportunity, if that makes sense. So you can write
totally.
I believe it was the 135, pretty out of the money. It's 3% out of the money, I believe, for Pepsi. You can write the 135 and buy yourself the insurance because you want to define your risk by buying the 131s. So that was the trade I recommended today.
This a bull put spread?
It is a put credit spread.
Yeah. Yeah. I mean, dude, Pepsi's beaten down, man. I don't know why. I mean, dude, there's companies that are like no revenue. Oklo is trading around Pepsi and has no revenue, but Pepsi's Pepsi and is trading at
Well, that's
less
the
than.
other reason I like it. It's beaten down because of market dynamics, not because of fundamentals, right? I
Mhm.
mean, anything considered consumer cyclical or defensive in nature uh, uh, are getting shunned like big time right now, as everything gravitates to, precious metals, Bitcoin, crypto, or obviously the king of the hill is AI still.
Yeah. What are you what sorry, expiration date is this?
That's the Friday,
Oh,
October 10th.
10th.
Yep,
Okay.
yep,
Interesting. So you said 135 and 131.
yep. I'm just letting my dogs in. I apologize.
135 and 131. Collect 60 cents. I don't know when you open this, but 66.
Well, I priced it out. I priced it out. Uh, yeah, you would collect about 60 cents right now.
Yeah. Yeah. I mean, I can't imagine. I mean,
Well,
even
here's a cool statistical fact, right? What if we just want to briefly give a preview to my presentation,
yeah,
when a stock trades um, at 2 standard deviations below the mean, what that tells you is that 95% of the time, a stock trades between 2 sigma below the mean and 2 sigma above the mean. And so you have a naturally built statistical floor in with Pepsi, again, because of market dynamics, not because of fundamentals with the company.
right.
And then speaking of fundamentals, my goodness, GDP now at 3.8% for the third quarter, right, suggests there's a ton of growth. And anecdotally, that would imply that a company like Pepsi that sells things to the consumer spending is still very strong. The numbers ought to be doesn't guarantee they're going to be good, but just reading the tea leaves, you have mathematics providing a nice floor. You have option premiums high because of the earnings and implied volatility around earnings. And you have a strong economy despite the fact that the stock is trading lower.
Yeah. Yeah, I totally.
A quick
Let's
question here, real fast. Jamie, you said you posted a trade for Pepsi.
Yes, it
Was that
is
in
on my
your?
Telegram.
Okay.
It was what I do on those free trades from time to time is I'll just do a short video explaining what the trade is. So it's in that rational trader video. If you go to my Telegram, you can view the video explanation of why I made that trade.
Perfect. Thank you. I'm going to post your Telegram in here a few more times so people can get on that.
So back on earnings whisper, the options implied move is 4.2%. What's 4.2% of 139? Just to be completely accurate.
Oh, that would take you down. Well, on the
$4
downside,
either way, right?
yeah.
So basically, so $4 either way, and we're trading at 139. So it would be, if it goes down, it would be right around that strike, and if it goes up, you would be about 144, right? So
And up to that strike, you're keeping 100% of that premium.
right, yeah, no, that's an interesting trade. And so you do these spreads around earnings.
We do. I'm doing this stuff. Companies are reporting earnings pretty much now 24/7. It's a
Yeah.
cottage industry, right? Primary earnings season obviously gets really busy. There's about a 6-week period there where it's just you can just, it's like shooting fish in a barrel. You can identify a lot of these 2 sigma mean reversion type opportunities, and then layer your fundamental analysis on top of it to give yourself the highest degree of confidence in the trade, which I like to do because I'm a poker player and I only
Oh,
like to
nice.
play the hands where the pot odds are as favorable as they can get.
For sure. Very cool. Yeah, so go to Jamie's Telegram if you want to get that trade. We can post it in here too. If you want to type it out, Jamie, for people just to get a little
Yeah, I'm seeing Manny asked the question, collecting 66, risking 334. Correct. Sell the 135, buy the 131. Put Friday expiration October. Let me just type in a message here. Buy to open.
Yeah, I'm trying to get my premium scanner to open too because we do these every Wednesday, but it's not working. Everything else is working in Thinkorswim. Why is this not showing up?
And sell to open. I'm sorry, I have that wrong. I wrote that wrong. Can I edit my little thing here?
No, just delete it.
You're good. You just sent that to us, so no
Oh.
worries at all.
Okay, so I'm going to send it to everybody.
There you go.
All right, and I'm going to sell to open.
Dude, why is my
PEP October 10 expiration 135. Put. And I'm going to buy to open the Pepsi October 10 131 put. So that's the credit spread I would execute in advance. And this is a trade that really is only good until today's close because Pepsi reports earnings tomorrow before the market opens.
Right. So if you do want to open it, you got to do it today. All right. Yeah, cool stuff. So I'm trying to get my scanner. I have this like super premium scanner we use to kind of find tickers to narrow down to sell premium on here, but it's not happening for me. I don't know why it's not loading. But I will say this Palantir trade, Palantir's in a nice little trend up right now. And I think we might be able to do a spread on Palantir today, just because let's see what premiums we can get for it. Not going to bet against the Panopticon. Let's see. So 177.50. Let's see what we're going to see if we can get maybe 175 to be safer. Let's see. So we actually took this trade a few weeks ago. I don't know if I did it in Profit Pan. I think I might have done it in opening playbook. We actually might be looking at the same trade, but if we do, we're to notch it down to 175 just to be safe. Let's see. Well, let's see what the. Let me see what the deltas are. And do you worry about deltas when you do spreads? Do you think about 30 deltas or whatever?
I do not.
Yeah.
Yeah, that's too for me, that's too in the weeds.
Mm-hmm.
But not, I mean, I'm not saying it's not a great tool for sure. Just for my purposes, just trying to keep things relatively simple.
Yeah, I use it just as a proxy because like the farther out of the money you go for these spreads, you do collect less premium, but you also have more risk to if the position goes against you. So if you take a 10 delta, you might have a 1 to 10 risk to reward to risk rather.
Mhm.
So if you collect a buck, you could lose 10 if something goes against you. So yeah, you'll win a lot, but like when it does happen, you're going to lose with the equivalent of 10 trades and one bad trade. Whereas if you take a 30 delta, which is what I usually like to trade on Theta on credit spreads, your win rate's going to be lower, but still not, especially if you use it and you identify good trends, like this one we got with Palantir. If you use it to identify good trends, when you use a 30 delta, you have a good mix of like you're not gonna the reward to risk is not as great. So for instance, on this Palantir trade, I'm gonna go at 24 actually. So I'm not actually using 30.
That's really interesting, Alex. I should take a closer look at that because um, I'm trading these in a buddy's account right now, who just loves to do this kind of stuff, and he 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 has a hard, even though the mathematics, the expected value theory on these trades are always in his favor. He gets really hung up on what you said earlier, which is I'm risking $10 to make $1.
Exactly.
And
Yeah.
and when we do find, and we do from time to time, we stumble across them, not because I'm looking at delta just by sheer luck. Um, the risk reward in this Pepsi trade, for example, is much better. It's less than 10 to 1. It's more like 5 to 6 to 1, right?
Mm-hmm.
And there have been other examples where the risk profile is closer to the 5, 6, 7 instead of the 10.
Yeah.
For whatever reason, I don't know, maybe you would know this, but it does seem like most often the risk reward is 10 to 1.
Well, it's purely, I'll show you what I mean. It's purely a function of, oh, I don't know. I don't know. It's purely a function, my dear sir. Sound like some like British archaeologist in the 1870s. Um, it's just like there's no free lunch. There's no free lunch, right?
Right.
So like if we look, let me move this over here. So you can see this. So if we're looking at this Palantir call, so this week I think I'm gonna open up and I'm gonna send it out to everyone. But it's about 24 delta. So we're starting, when I say 24 delta, it's the sold strike that I'm talking about. Our net delta is going to be actually less because we're also buying this one. But I use the delta to anchor the short strike, whether that's on the call or the put side. But like if you were to take a sell the short all the way down here at 170, right? It's just there's no free lunch because this is going to be really high probability, but also when it goes against you, right? Because this long option, so this is a put credit spread, which means you want the stock to go up. So this is the short put that you sell. This is the long put, right? And because that long put is basically so far out of the money, you just don't, it doesn't compensate as much for this price breaking through this short strike as much as if you're up here at 177.55 or so. Whereas if it breaks through, you're going to get a little more pop on that long call. And 25 to 30 delta, I just found like the win rate, if you can identify good trending stocks, I've just found that like, yeah, you might lose a few more, but you're not going to really, because you will lose the 1 to 10. I know it seems unlikely. You will lose them. I've had it happen to me.
So it's I love this is the you're in my sweet spot, right? You know, the probabilities and the statistics of this really go hand in hand with this idea of 2 sigma that we're going to be talking about a little later. And it somebody mentioned that, you know, these kinds of risk reward positions are scary, and that was well said, whoever said that. And because that's very real, right? From a trading perspective, sometimes things are scary. And the way I you know, try to resolve that fear or scariness, if you will, is by putting the odds in my favor that I am going to be right. And I know, you know, when you're taking 10 to 1 risk, then theoretically you're going to make 10 trades, 9 of them are going to win, and that one that loses, and what have you done for yourself? You're right back to even Steven. And so, you know, what using 2 sigma and understanding that this reversion to the mean concept is very, very powerful. Even if you just incrementally increase your win rate to 13 out of 14, then, you know, you should have comfort making these trades all day long. Now, my buddy hasn't been able to get there with that. You know, we're going through this really interesting period where he would much prefer, okay, in Pepsi's case, reversion to the mean means we want the stock to go up, so why not do a call debit spread? Okay, well, the risk reward on that looks way more attractive than the risk reward on doing a credit put spread. But invariably, he's more comfortable, but he's losing more because the premiums, you know, on these particular trades, the premiums are so ghastly, outrageous.
Right, especially before
it's really hard to come up with a structure that you can rely upon to trade, you know, regularly, utilizing these concepts of 2 sigma and premiums because of earnings, right? That's what we're trying to marry here with this particular idea. So I get that the you know, the risk reward doesn't sit easily, but I like what you said, Alex. There's no free lunch.
Right. You need to have, if you're, you always want to have a reason that you're taking the trade. That can be the 2 sigma stuff. It can be the trends. It can be trend lines. It can be a trending stuff. What's just, again, coming back to the whole training we did, like what's your rationale for this move that you expect, right? Because if you have no rationale, you're just like, oh, it kind of looks like it's going to go up. It's not going to work out. You need to have some other layer that you use to create a higher conviction trade. But yeah, so you know, that's why I just personally like 30, because it gives me, I know my risk basically a 30 delta is going to give you a 1 to 3 risk to reward. So for every dollar you get, you risk $3. But if you do layer on, really what I do here, which is just technical analysis on the chart, like trend lines and stuff, if you can bump that, you bump that rate up, your win rate, which is solid. I mean, we've been doing well. Like for our cash flow club, we do these spreads every week on Apple, and we use different price levels and different resistance and support lines, and it's been great. And we take like 30 to 25 delta, and that just, but when with that 30 delta, if you do lose, it's not as large of a loss. And I think there is, just for me, is for it too, and I think a lot of traders, some psychological benefit to knowing, a 1 to 3 loss seems a lot easier to stomach than a 1 to,
now that we're diving into it, I don't have access to the data, but can you look at Pepsi and find a 30 delta? What strike would we have to sell to get a lower risk reward profile?
Yeah, let me go. Before I do that, let me just go ahead. I'm going to drop this Palantir trade in the chat, because I'm going to open this one, folks. So for everyone, I got to get the chat back up.
And I apologize if I'm distracting you from what you're trying to do here.
Not at all, man.
This is a great discussion for a lot of different reasons. And I hope everybody finds value in what we're talking about here, because in a moment I am going to be talking about 2 sigma in much more detail, and for those of you fascinated by statistics, you'll want to stick around for that.
Yeah, for sure. No, I'm going to stick around and watch it, because I'm curious. All right, so I'm going to try and get into that spread I just dropped there for I'm going to try and get 139. I just dropped. Let's see. I'm sorry, for 39 cents. Let's see if I can get it. Boom, ba-doom, boom, ba-doom, boom, 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 ba-doom. All right, I'm gonna hold it. Try and get in for 39, because the higher you get in on a spread, again, because you're selling, you want the option to decrease in value. So if you look at this, we want Palantir to go to 200 by tomorrow, and then we'll be like looking hot, right? You want the spread. You don't want it to go down to that short strike, which in our case is the 175. Oh shit. Wait, I did the 175. I meant to do the 177.50. 177.50. We want it to stay above 177.50 by Friday, which we have a good strong trend here. We have a huge sell-off in this puppy on Friday. So I think, like, I don't know. Talk about statistics. I don't know what statistics it is, but that seems like a statistical anomaly. Like, statistically, you think it's, especially Palantir, which is a market, really strong market leader right now, that's going to go up. Brandon, those are puts. It's a bull put spread. So with credit spreads, it's inverted from like a long call and a long put. A bull put spread means you want the stock to go up, and a bear call spread means you want the stock to go down. Normally, a call means you want the stock to go up, and a put means you want it to go down, but it's reversed for spreads because of that short strike that you're selling. So let's look at Pepsi. Let's look at Pepsi, and then I want to definitely get into that thing, because I'm very curious about it. But I also want to look at some flows real quick on my app, because we do these overnight flows from these late day pops, and some sweeps. Faith. Okay, calls mean going up. Puts mean going down normally. With spreads, with credit spreads, a call spread means you want the stock to go down, and a put spread, when you're on a credit spread, which means you're collecting the money up front, a put spread, you want the stock to go up. So with credit spreads, calls and puts are reversed. Vladdy, yeah, is Poet moving? Man, yeah, whatever. We got out at 110. I'm happy with that. Jean is asking, she's never done a spread. She has Robinhood. Do I place the sell to open put first? You usually can batch the orders, like on Thinkorswim. If you have like a little drop-down menu, it says vertical. I can't use Robinhood. I lost my username, and I cannot get in contact with them to open up another account. So I do not know how Robinhood does it. I'm sorry. maybe Blake, if he's uses Robinhood, can chime in there and help people out, but I do not know what they do.
No,
Okay.
I'm sorry.
So,
I use Robinhood for just simple puts and calls. That's about
yeah.
it.
Yeah, okay. Let's look at this Pepsi real quick. I'll open up this options chain again. Share this puppet. Okay, so 136 would be 136 or 135. And you had what was your
We sold the 135 and we bought the 131 was the recommended trade.
okay, cool.
And then when I priced it out, it was around 72 cents. It looks like it's now between 60 and 65 cents.
Dope. Yeah, I mean, so that's about what's the price action looking like? 136. I mean, so 135 is like also just from a chart pattern. Like, look at this. Like, 135 or 136 actually would be kind of good. Your 135 for me would be maybe even just based on the chart because it's below the consolidation before the breakout here. Would actually be a little conservative, but 136 is right at that top level before we broke out, which could form like a support line for a put spread. The thing, so that strike is actually like I kind of like the 135 strike to be honest. Now this is a wide spread, but I assume because you're doing it wider because you want to collect a little more premium if you just did the a $1 spread. So if you did a 135, so this is what it looks like on Thinkorswim because you can just go over here in vertical. So you collect $24 for a 135, 134. That's going to give you a little better delta, or not. It's going to give you a different delta, right? Whether it's better or not bases on your own trade style. But it's going to give you. You're going to have basically 20 and 25. You're going to be like basically a 1 to 5.
That's yeah. Well, 25. That's 1 to 4, isn't it?
Yeah, but then you have this delta here. So it's like 23. So yeah, like 1 to 4. It's like 23, 24 net. So yeah, so basically 1 to 4. It'd be a 1 to 4 at the 135 level with this dollar width strike price.
So with a 135, 134. Yeah,
Yeah.
that's interesting.
Yeah.
I mean that
Um,
you give up 40 some cents of premium, but if the other side of that coin is you can just sell more contracts.
right. You can get the same amount of money depending on what you want to do. You just notch up the number of contracts. So, yeah, I don't know.
Yeah, because you need to, I mean, it needs to be worth your while, right? I mean, at some point, and I kind of arbitrarily, $50 is kind of like my uh, floor or threshold, for credit spreads in this style.
Right, because you don't want just to get a dollar. You could make a dollar all day long.
Yeah, right. I mean, how many ways can you make a buck?
Yeah. Actually, that might be a good product, just like dollar, just like
Yeah.
like
Where are we
$200 with spreads every
We should
every
do that
week.
together. Where are we going to find our next dollar?
Yeah, do a ton of credit spreads that are so far out of the money.
We're just gonna be doing credit spreads all day long.
Yeah. Pretty cool stuff. I mean, it's it's right at the earnings whisper, like expected move that your trades. I mean, let me know. I'm gonna watch it. People got it. I think some people entered it. I'm gonna be paying attention to Pepsi tomorrow, see how it goes. Because it's right at that expected move. So I mean, I have a feeling that this trade is gonna win just because I think that this sell-off in Pepsi has been, especially from like here, has been a little bit undue. It wasn't deserved. I don't, Pepsi's a big company. I understand the money's just rotating into the meme stocks or basically meme stocks. But most of these stocks are meme stocks these days. But I mean, Pepsi's not going anywhere. So I like it, man. I like it. I want to. Okay, so we're at 3:30. Let's look at just one thing here real quick. You can see we got even more open stuff. We have some puts coming in now too. It's going to be a battle, man. I'm staying in this trade. We'll see how it goes tomorrow. But it looks like overall the call put skew is or not. It's not 10. The call put balance is higher to the call side. So I'm going to stay in this for 10-10 until tomorrow. Let's see if we got some XYZ coming in late for 10-17. Do we have any others coming in here hot? Let's see. Sound for 19. What's sound trading at now? $18. Let's see. Anybody else got any hey Matt, thanks for all that Robinhood info for everyone. And Glenn. I know that's very appreciated. Helping each other out. That's we're trying to build a community here. That's what I like to see. So you got some bull stuff. Just trying to see if we yeah, we got a lot of bull contracts coming in, don't we? See what I got over on the scanner. Anybody use Webull to trade? Man, this thing is hurting. Damn. A big old volume spike today on, wow, look at that. This is just trading volume too. This doesn't even encompass the options volume. So we've got some Webull stuff. Yep, later.
You don't want my opinion on Webull.
Oh yeah, you don't like Webull?
No. They'll close you out like 15 minutes before market close on SPX and XSP calls.
Oh damn.
Yep. Missed out on like a couple grand one day because of that.
Damn. Yeah, they're I guess they have some. I guess they I'm sorry, I just saw my Palantir and opened. I'm gonna go in. I'm gonna get in for 35 on Palantir. All right, I'm in for 35 on Palantir. Velati's saying a lot of ARM calls hitting. Let's look at ARM. I mean, bull would be, I wonder if it's cheap, these calls. Probably. Man, yeah, there's a lot, but there's also there's some $17 calls. All right, well, look, I'm gonna get check my Telegram. I'm gonna well, I want to get Jay-Z. I want to listen to this. I'm gonna go keep on scrolling through here. Everybody's got that Palantir trade. I'm gonna send out this overnight sweep trade to my Telegram. So Blake, if you can just drop my Telegram link. If you're not in there, get in there.
I got you.
I'll send out this one while JD starts his thing. JD, I'm gonna cede the screen to you, man. I'm gonna listen to this while I sort of scan and try to figure out a good trade, so we don't just sit here while I'm cogitating and stuff.